All right. We are live. See, we got all the socials up. All right. Well, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. And I'm joined with my good friend, Doug Hagren. Hey, Doug.
Hey, Kirk. How you doing? Long time no see.
I have to say, I got a great night's sleep last night, Doug. You know why? Is that I got, and this is not an advertisement. I got a chili pad. I don't know if anyone's ever heard that. This year is my year of health, and I'm doing everything I can to improve all aspects of my life. And 3 days ago, I got the chili pad. Once again, there's not an advertisement. I wish they would pay me. And by the way, if anyone from there sees this, please send me a check. But it's been really fascinating learning about sleep and the different cycles you go through. And first night I felt great. Second night I felt like crap. And tonight I feel great. Today I feel great. So we'll see. They say it takes like 2 to 3 weeks to tweak it, but I'm really loving it. I have to say, if you guys haven't tried it, highly recommend it. It's especially good for women above 40, 45 when they get into the menopausal stage. I heard it's really good from a lot of friends. But as a guy not having any part of that, I'm loving it. So for anyone who's not tried that, you should look into it because it's kind of cool. So I'm feeling spicy today, Doug. Got all this energy from having a good night.
What you just described, Kirk, is what I deal with every day, whether I have the chili or not. I slept great. I slept like crap. I slept great. I slept like crap. Except I didn't invest in the chili pad.
Yeah, they had one feature at the end where it's like, like 15 minutes before you wake up, it goes into high mode, which apparently goes up to like 115 degrees. It was awesome, and so awesome I didn't want to get out of bed, so I don't use that feature anymore because I literally couldn't get out of bed. I was like, I feel too comfortable. I'm just going to hang out here. So yeah, it's a cool thing. I know there's a few competitors out there we looked at too, but technology is a wonderful thing, Doug. I have to say, it can be. Yeah, I'm a little peeved at the. I've got an Oura Ring, I've got a phone app, a sleep app, and then I've got this thing, and everyone's keeping metrics on me. I wish there was just one. You could just have one that kept all the metrics, but everyone wants to have a subscription service. I guess that's the theme for this decade is subscription services as a business model.
Oh yeah, I mean, I remember when Google was free, storage was free. Then they tricked everybody to using Google Photos and putting, hundreds of, gigabytes of their photos and everything on there. And then they decided, it's not free anymore. Now you're gonna have to pay us. And now, just to keep my photos and other crap and use my Gmail, I mean, I'm spending $20 a month on terabytes. Yeah. Gotta love it. And I'll be locked into that forever unless I want to download it to a hard drive. That I got a multi-terabyte hard drive, but then everything's on this hard drive, which A, can fail, and B, who's going to access that? So they did say today I can share my because now my wife's out of space, and so Google is telling her, well, you can upgrade. So that's another load there. Now it did offer me an opportunity to share my space with up to 5 family members. Okay, great. But they're going to double my cost to do that, even though the space doesn't increase.
It's really interesting. I mean, when Microsoft started doing it, everyone kind of basically tarred and feathered Microsoft for killing their business model and saying, oh, well, instead of charging, $300 or $400 for software, you're now going to charge like $20 a month or whatever it was, or $10 a month. And everyone just totally pilloried them. And meanwhile, Microsoft's like one of the best performing companies out there. And so everyone's seeing that and they're like, oh, I want to get on board. I want a subscription model. I want, reoccurring revenue. And I've seen some of the dumbest business models dump their stuff into reoccurring revenue. And it's like, why would I ever pay for this? Like, why am I paying for this stupid thing? Like, I mean, there's some that are annoying, like the Oura Ring. It's like you got to spend a few $100 for the Oura Ring, and then you got to spend. It didn't used to be this way. It used to be free, but now they charge you like a monthly fee to have this access to your data. And it's like, come on, you can't charge me for a big upfront and then also charge me a monthly fee. That's ridiculous. Like some business models that are like one and done. They're like, oh, you can stick on for a monthly recurring revenue. I've just gotten to the point, like I said, I'm spicy today. I've gotten to the point. I was talking to a friend of mine this morning, and maybe it was even you, Doug. I was talking to somebody, I can't remember. Oh no, it was an account I work with, and we were talking about like business models that are horrendous. Now, it used to be that the big monopolies, like the Comcast, the world, the Verizons, there's really only one or two. There's oligopoly, but basically it's one big company. And you see you work with them, and the customer service was never great, but you could always kind of like finagle your way in. You could say, well, I know somebody, and you get into you find the special VIP customer service. There's always a path there. I'm totally convinced that these companies who have outsourced their service to India or some other foreign land for cheap, I'm 100% convinced that not only have they outsourced their stuff to India, which has been happening for a long time, but they've actually trained their customer service people to be inept. And I don't mean India. I mean the people domestically. And I won't name these companies because they're public, but one company I called, I had an issue, and I called them, and I was trying to work through it, and it was an error in their part, which, by the way, I don't know if anyone's ever noticed this, but there's errors all the time on your bills and other things, but it's never in your favor. It's always in their favor. I haven't caught an error that was like, wow, that's really lucky that I got, like in Monopoly, it's like bank error in your favor. You get $10. Nope, haven't got one of those yet. But so I called this company. I'm talking to their customer service person, and they were so inept that it couldn't have been accidental. Like I was trying to talk to them through, and the way they were answering me and the way they were pivoting was almost, I'm 90% sure it was deliberately ineptitude. And you say, well, why would they do that? And the reason is because they want to frustrate you to go away. So I'm convinced that many of these big companies with really terrible customer service have built in poor customer service. You go away, you get frustrated and you go away, and the errors in their favor, they just get to keep. Now, the IRS did this in 2008. I had some issue that I was, it was some error, and I called them on it. And it was basically, I sent in my check like April 15th. And what they said was, no, we need to receive the check by April 15th. I'm like, no, that's not how it works. And they're like, no. I'm like, when did that rule change? They're like, oh, it's always been this way. I'm like, no, that's not how it works. And so I talked to this person who was trying to convince me that I needed to have my check received by them by April 15th. I'm like, no, you have to mail it by then. It's kind of a general rule. And they were trying to convince me it wasn't true. And it got to the point where I'm like, did they change something? I wasn't aware of it. So I was like, you know what? Let me talk to your supervisor. Talk to the supervisor. Same BS. Nope, that's the rule. Look at this publication. I'm like, I'm looking at the publication. Tell me where it is. They're like, it's in there. You got to find it. I'm like, no. So I call my accountant. I'm like, what's the deal? He's like, no, that's not the way it works. I was like, okay, so I'm not losing my mind. Anyway, so the point is I talked to 3 people that day at the IRS on that same phone call. Every single one told me the same story. And that was back when it was a mess and they were hiring people and no one knew what they were doing. Point being is a lot of these big institutions now, in my opinion, are deliberately inept to frustrate people so that they get more money. And so I don't have any evidence of this, but if anyone does, please let me know. I would love to feature you on the show because I want proof that this is happening because I suspect it is, and I don't have any firm proof. So anyway, that's my rant for the day. I got to get that spice out, but I want to talk about.
Can I counter that in one regard?
Please.
What customer service? As technology's taken over everything, they don't even have a customer service line. I've been talking about this with people for a week. It's like the eliminated, the antisocial aspect of people who are predominantly technology focused has now become the dominant industry in our country, and they don't even offer it. Like Google doesn't have a customer service line. Facebook doesn't have a customer service line. You need help, you got to go to Google forums and hope some expert out there is going to answer your question eventually. And that trend, which comes from, we don't need help, don't want help, and don't want to deal with people, has now become that focus has become the predominant focus of corporations and entities everywhere. Like, it's good luck. And, we're talking about having AI driven customer service agents and things like that. And to some degree, I think it's incredibly valuable, but that's only within the limitations it has in terms of getting things fixed. Like, AI is not going to be able to humanize that conversation.
AI is terrible. I mean, I've seen a few places where it's an AI generated response. I'm like, I don't need a response. I need a customer service person. And you can't get one. So like Google, for instance. So I signed up for Google Suite. I think it was last year. And I started using it, and they would not allow me to use most of the apps. Like, I paid for it. It wasn't like a free subscription. This was a paid version. I couldn't use YouTube for like 2 months. I couldn't send more than a certain number of messages. And I was like, and I couldn't call anybody. And I found some weird way to get access to support. And I was yelling at them. And I was yelling at them. I was like, why am I paying for this crappy service? They're like, and I understand where they're coming from, because I found out after, I guess what happens is a lot of these spammers will sign up for this service for a month, and they'll just spam the crap out of everybody, and then they'll shut it down. They'll do it again. And so they have this filter as a buffer. Well, you can only do certain things. I'm like, well, why don't you just give it to me for free? Like, why are you making me pay for this awful service for 2 months before I actually can use it? And so I have some empathy. I'm not just, ranting here. I have some empathy for some of these companies, because I get the challenges that they're facing. But most of them are not. Like the earlier rant I had was clearly they're just trying to frustrate you. But this one it was actually for a purpose. And so I don't know. I think we're in a transitional phase where AI is helpful and yet not helpful at the same time. I really don't like the AI versions. Just give me a real person to chat that understands the nuance. Because if I have a question and I get a response back that has nothing to do with my question, or you clearly didn't read my question, you just read off a script and assumed you knew what I meant, that really frustrates me. I have to like respond back, nope, that's not what I asked. Try again. And eventually you get somebody, but it's such a waste of time. And so I hope AI gets there quickly, because it has gotten so bad with service in many of these companies that I think AI is the only solution. As bad as it is, it's still better than what we're getting. So I don't know where that goes, but I hope it goes there quicker, because I don't think I could deal with it. It's beyond it. But anyway, enough of the ranting. Let's get into real stuff. So Warren Buffett came out with his annual shareholder letter. We're going to talk about it next week, because I have not had a chance to read it. Doug has a little bit, but I did want to share a little bit about, we talked about it last week, the Buffett indicator. And this is just really showing how expensive things are. Now, if you look at this shows by standard deviation, by historical trend lines, which basically means that we're way above where things should be. So if you look at the stock market right now, and let's just assume for the moment that it goes from 2 standard deviations up to 1.5 down like before, I mean, you're looking at a 75% drop in the stock market. Now, I'm not saying this is going to happen, so just bear this in mind. So I'm using this indicator that he's used for a very long period of time. I think it's a very reasonable indicator. What it's suggesting is effectively that if you're using the reversion to the mean theory, which if you don't know what that means, a little education tip here. Reversion to the mean is if you look at the stock market like an oscillator, right? It goes up, it goes down, it goes up, it goes down. And there's a line in the middle that is generally going up, but it'll go up and down around that line. So right now it's on the high end. Sometimes it'll be on the low end, and it goes up and down, and it does this every year. It does this every few years. There's short-term cycles. There's very long-term cycles. This is a 75-year cycle that we're showing. You could do this on a daily basis too. This is just how markets work. They don't just go up, right? Or they don't just go down. They oscillate. They go up and down. And so this is a version. And basically what the reversion of the mean means is that if it goes an extreme measure in one direction, it will tend to go in extreme measure in the other direction. And then it'll find a happy medium. So it's like a beach ball, right? The more you push it under the water, the higher it'll go, and eventually it'll settle on the water. What we're seeing now is a very high exaggeration on the upside. It's 2 standard deviations above the historical trend line. And basically what that means is you're looking at a big drawdown when it drops. And so I'm not saying this is going to happen, but when it does, and it will happen at some point, it's not going to be pretty. So if you are not prepared for this, then you're in for a rude awakening. Now, let me hit one more chart here, and I'll let Doug talk about the annual letter. So, or 2 more charts. So here's, you know what? Let me just hit this chart. So, so if you look at this chart here, this is Warren Buffett's Berkshire Hathaway, his company Berkshire Hathaway, and this is cash as a percentage of assets. So for the last 25 or whatever it is, 30 years, this shows every single year what percentage of cash as a percentage of his holdings. So Warren Buffett runs a company called Berkshire Hathaway, which is a property casualty insurance company. Or let me rephrase that. Most of what his assets are based on property casualty insurance or reinsurance. And the cash generated from that he uses to buy assets like, you know, Coca-Cola or McDonald's or companies like that he likes. And so during certain cycles, he'll be close to fully invested, and there's certain cycles where he has a very heavy cash portion. Now, if you look here, 2005, he had one of his highest percentages of cash. It was close to 25%. In 2010, he put much of that cash to work through the financial crisis. If you guys remember, he bought. He got a lot of sweetheart deals that no one else got. You know, like he got a sweetheart deal on Bank of America, on Goldman Sachs, on a few others.
B&O Railroad.
Which one? Yeah, he bought a railroad, which I thought was a dumb investment. But if you look at what he's done, he's made some really great deals. But as you notice, when things get expensive, he tends to have a lot of cash. Right now, he has the highest cash portion in the last 25, 30 years. He's got close to 27.5% of his cash as a percentage of assets. He's sold down a lot of companies like Apple, which is a big holding. So he sold off a lot of that. He sold off a lot of Bank of America. He sold off a lot of the financial institutions. I'm not sure if that's telling for them or if it's just he's trying to free up cash and he's trying to pick the low hanging fruit. You know, obviously this has been going on for a little while, for the last few years, where he's had high portions of cash. And this doesn't mean that a crash is imminent. I want to be really crystal clear. This does not mean a crash is imminent. What it means is he is seeing the overvaluation that we talked about last week and a little bit this week. And a lot of other people are seeing it too. It's not a secret. But it doesn't mean that it can't be more overvalued. That is a truism. The market could go a lot higher than we all think, given we have a new administration, good or bad, or good and bad probably. And, you know, there's a lot of unknowns. There's a lot of disruption. There'll be a little good, a little bad, and we'll see where it shakes out. But everything's really expensive. So if we came off 30% in the markets, it would still be expensive. You kind of go back to that old chart, it would still be expensive after 30%. So it would take a historical crash like a black swan event or something to cause a crash, which at the moment I'm not actually seeing. So I know there's always something, you know, Japan, potential black swan, which has been there for a long time. Other countries, potential black swan. I mean, withstanding a world war, I think there's very few black swans out there that I'm currently concerned about. Not that I don't know that they exist, but just they're not high probability at this point. So I think the big question is well, we're expensive, but we're not egregiously expensive in the sense that we could see the market pull back 30%, and that would be a normal valuation. But it's not like the companies. So if you think back for like the last 25 years, the tech bubble burst in 2001, and it was ugly. I think the NASDAQ went down like 70 some odd percent. Some stocks haven't even come back. Like Cisco hasn't even come back to the all-time highs in the 2000. So, it was a mess. And 2008 was a mess for housing. That's come back. COVID was a mess for many companies, but a lot of these companies have come back. But those events caused a disruption, and they happened. The housing was because people were paying stupid money for houses that they shouldn't have. They're way over leveraged. You see the movie The Big Short, where they're hyper leveraged. They're showing in one of the scenes in the movie, there was one of the guys doing research, and he was talking to a stripper, and the stripper's like, "Yeah, I got like 20 houses," and she didn't know she could lose money. Like it was just a funny scene. But the point is like there were people who were just buying houses because you could, and so a lot of bad stuff happened then. But people were causing that bubble. In the tech bubble, people were causing it. They were paying stupid money for companies that didn't make sense. We're not seeing a lot of that same excess right now. So even though things are expensive, it's not like we have a ton of leverage. It's not like the financial system's broken. It's not like the housing market's broken. We have a sovereign debt problem that's broken, but that could go on for another 20 years because they're making the rules. So just to be clear, like we're all aware there's a problem there, and I hope Elon and Trump are able to fix it. I'm not sure it's fixable, but I'm hoping they can, because we're up the creek in about 10 years if they can't fix it. And so I have major concerns about that, but that's not an immediate problem. So the point being is we don't have anything on the horizon that is an immediate effect to cause a crash. I'm just not seeing it. I mean, COVID was different, but nobody could have first saw that. But even that, the markets were up for the year. Even though we had the whole world shut down for months, the markets were up for the year. So my point is I'm finding it really hard to see the pivot. What's going to cause the markets to pivot? I could see flat markets for the next 5 years as the solution, and that could solve our problems. But anyway, I just wanted to share that with the overvaluation, because I mean Buffett, he's generally, I mean, the guy's old as dirt right now, so I don't know how sound his thinking is still, because I just don't know. But presumably he's still pretty sharp, and he's making good decisions, but he does have other people helping him, so it's not just him. But I would imagine that given all that's going on, it would be really smart to raise cash and to have some dry powder. So if the market does crash, and we'll talk about some markets that are volatile this week. But yeah, I don't know. What are your thoughts, Doug?
Well, I think my thoughts, well, first of all, one of the things that, is happening right now, yes, the markets have been volatile recently, but I just looked it up. I mean, February, we're only down about 1.8% in the S&P for February, which is pretty anemic if you think about the overall impact. And I know people are starting to get a little bit skittish here and there about what's going on, because they're starting to see some pretty volatile days, especially with crypto, that people haven't seen in a while. And we've talked about this before, but I'll talk about it again. There's percentages are the same no matter if you have a small account or a big account. The larger your account, though, the translation of percentages into dollar amounts changes significantly. So I mean, if you have $50,000 and you have a 10% drop, it's $5,000. And a lot of people will look at that and say 5,000 is not that much. Well, if you have $1 million portfolio and you have a 10% change, that's 100 grand. And so a reminder to, to anybody that's watching and kind of looking at what's going on right now is to keep in mind that, if you're fortunate enough to have saved really well and to accumulate more, very small shifts percentage-wise that occur in your portfolio of the markets are going to translate potentially to significant dollar changes. But it's all the same. So, it's hard to kind of translate the dollars and the percentages back and forth, but that becomes more of a reality of what's going on. We really haven't shifted that much in the markets, even with more of these volatile days recently that have occurred. The other thing is you were talking about kind of, having cash, access to capital. Big fan of that because it's not necessarily that you're panicking. Warren Buffett's not panicking. He doesn't hold cash because he fears the markets. He has said this before, that the reason that he holds cash is because he wants to be opportunistic. He wants to be able to ebb when everybody else is flowing. He wants to be able to figure out that when the tide goes out, he's not swimming naked. He's able to take a look and say, look, I've got an opportunity to pounce on that. So, the reason to have cash is not because we have seen a significant risk that's occurred, but because there is risk there and nobody knows when that risk may manifest. Having those abilities, to be able to move in and be opportunistic are going to be key long-term. One of the things that I see a lot is I see people talking about, well, buy the dip. Well, buy the dip is great if you're referring to the ability to be liquid enough to be able to buy the dip. Buy the dip is not dollar cost averaging. If you're just throwing a little bit of money in all the time and the markets pull back, yes, you're going to be able to take advantage of those reduced valuations, but only with that relatively insignificant amount of investment that you can make out of your cash flow. That is not being opportunistic. Opportunistic is knowing that, hey, I've got access to something where I can make a big shift if there is a sizable shift that occurs, and being able to then truly take advantage of the whole concept of buy low, sell high. So that's a couple of thoughts on that. I want to go back to the shareholder letter and talk about some of the things that occurred that he talked about. One of the things that he was mentioning in it, that he's trying to be transparent in leadership, and openly discussed that they've made some past mistakes in capital allocation and management selection. So he's saying, look, part of what's made them successful is the ability to learn from those errors, make corrections quickly. They've had a strong financial performance. I've said this multiple times, and if you take a look at the top 10 performing sectors out there in the S&P 500, if you look at the top 10 holdings, it is pretty much, the Mag 7, a couple more tech companies, and then Berkshire Hathaway. It continues to remain a darling in most people's portfolios, and it's done well. Operating earnings were $47.4 billion. That was up from $37.3 billion in 2023. Think about this. He's sitting on all that cash, Kirk, and yet still able to increase their operating earnings by $10 billion. They really did a great job in the insurance business, major profit increase, especially in Geico's turnaround under the new CEO, Todd Combs. I think, they've obviously literally, Kirk, weathered the storms that occurred there. But there's also, that comes at a cost to consumers, because there's absolutely been a lot of talk over the last year about the spike in costs that have come to consumers over, especially in property insurance and auto insurance. Railroad and utility segments. Even though there's been economic challenges, you talk about Burlington Northern, it actually turned out to be a pretty good payoff. Nobody can really look without diving too deeply at how that's been, because he bought it completely. He didn't just invest in the stake of it. So it's not public. It's part of the Berkshire Hathaway, but they have seen improved performance despite those economic challenges. They paid about $26.8 billion in corporate income tax. That's more than any company in U.S. history. So if anybody wants to talk about how the rich don't pay taxes, that is a massive corporate bill. Never been anything more. There's been, he talked about the importance of reinvesting in America rather than issuing dividends. So they can continue to not have dividends. They're going to continue to hold that cash and use it to be able to have capital deployment. Speaking of that, they're going to continue to maintain that huge equity position. They are still very cautious about not buying new businesses. They did increase stake in Japanese firms, Itochu, Marubeni, Mitsubishi, one that people would recognize, Mitsui, and Sumitomo, highlighting their disciplined management, shareholder-friendly policies. So very bullish on Japanese companies. Property and casual business provides a float to invest in long-term opportunities. So they're going to continue to use that competitive advantage. That float has actually grown from $46 billion in 2004 to $171 billion in 2024, over 20 years. That reinforces their unique financial strength and the long-term investment in equities, not cash or bonds. So he continues to prioritize equity ownership over cash or bonds, stating that businesses remain the best hedge against inflation and financial security. Now, what are some of the issues? Stock portfolio decline. Their marketable equity holdings fell almost $100 billion from 354 to 272, suggesting fewer attractive opportunities. The heavy reliance on Apple, American Express, and Coca-Cola could be a risk if there's those companies downturn. There's convective storms and climate events that are increasing costs for insurance companies. Warns that if a major unpredictable insurance loss could occur, if that would impact future profitability. So they're relying a lot on their ability to manage that insurance piece. While those insurance investments performed well, 53% of their 189 businesses actually saw declining earnings. Railroads and utilities have much left to accomplish, even though they've improved. They have not improved as much as I think they would predict. I would say, massive size is going to be an issue. This kind of comes back to some of the mutual fund companies out there that are huge, make it very difficult for them to move quickly in and out of investments. And Berkshire has the same problem. They are limited in their ability to move by their size because of the impact that can have on markets, and large term scale deals are getting harder to find, which limits high return opportunities. But the biggest one I think that comes into play is, as you mentioned, his age. He's old as dirt, or maybe not quite as old as dirt, but he is now 94 years old. He has reiterated that Greg Abel is going to take over, but I think there's still a lot of uncertainty of investors as to wonder whether or not they can maintain that same culture and disciplined strategy. I want to talk about some of the warnings that he put out there, things that investors could focus on. Again, fewer attractive stock opportunities and high valuations. That goes back to what we said. If he implies many stocks are overvalued, it's hard to find those investments at reasonable prices. The ability for them to make those moves, equity portfolio shrinking. Again, what's the takeaway for investors? Stock market gains might slow down. Investors should be cautious about chasing overpriced stocks. Again, whether you're in Berkshire Hathaway or not, that is a translation, as we said, to does it make sense to be nimble? Yes, you might buy of markets, but there comes with the downside of tank and cash, something that gives you flexibility. The other warning is those extreme events, unprecedented insurance losses. You can talk climate change all you want. Who knows climate change better than anyone? Insurance companies. And there has been, there is an increase in climate-related disasters that are increasing costs for insurers. Noting convective storms, those fast, powerful ones that come in, direct that cause a major spike in claims in 2020 event, but one could come at any time, and he's concerned that some insurers could misprice massive financial loss in the industry. So the takeaway,
you're coming in a little shot.
Oh yeah, I'm seeing you're kind of blurring out for me too. Sorry.
Yeah.
So we're having some buffet. We're having some buffeting to do. Boom.
Buffeting issues. Yeah. So I want to make a comment on this, and we can kind of pivot because we'll do this a little bit more next week.
Okay.
The thing of it is he's really smartly the most successful investor of our era, or at least that we know about. I mean, there's some others too, but he's at least some of the most. He's in the top few for sure. And I think his model of investing is very different from all the others that would be in his field. And he has made some mistakes. And I point this out because I think it's important that people understand that is. a mistake based on how I'm characterizing him. It's a mistake characterizing him. Everyone's got different standards. My standards are different than his, from Doug's. So I'm only using his goalpost to measure himself on. Not my goalpost, because my goalposts aren't. So using his goalposts, he used to measure his performance in a 10-year rolling average. A bunch of years stopped doing that because he wasn't beating it. And I forget what year it was, like 2012, 13, something like that. But he was beating it until back, probably a few. But he would always beat the index, and then over a 10-year rolling average, and then he stopped. And then measuring it. So by his own standard, he was not being intellectually honest. Now, most in industry, not altogether intellectually, not like it was a surprise, but I pointed out because it was his own, and he said, "Well, my standard is the 10 average." He's beat that for a long time, not supporting it. I think his reasoning is basically there aren't an opportunity to probably not as many opportunities for him to find, but that he's still held to that standard. He still has to figure out what to do with managing. So just the fact that it's too big doesn't really give him an excuse. He has to find a way to solve that. So that's one of the things that I think pointing out. There's another one when he bought the railroad, and by his money, it's the same thing. He has a method of buying capital efficient businesses, and that's really that's buying efficient business that effectively he doesn't have to keep funneling cash. And so roads, I thought that was interesting. He bought, I forget which oil company, in the early 2000s, and he ended up selling for a loss. And he again, I guess we're getting some connection. That's not what I wanted. Wow, it's getting really wonky here. All right. Well, I'm going to try to wrap this up because we're having issues here with a lot of stuff. So anyway, kind of wrapping it up here. The point being is, by his own standards, he has been failing recently, and he's been making bad decisions. He bought Apple, which I'm surprised he didn't buy. I guess was his number two bought. I think it was Combs' decision, but and it was a good decision at the time. But now he's selling. But the point being is, if you're creating your own standards, you have to be held to those standards. And by his standards, he has not been performing up to his old self. Maybe it's due to age, maybe it's due to the size of it. There could be many factors, but I just point that out because you can't just blindly follow people who've had success and assuming that they're always going to have success. He has some big hurdles he has to overcome, and I'm not so sure those are going to be easy hurdles to overcome for him. So in the interest of bad connections here on our platform, let's wrap it up. Doug, final thoughts. Where can people find more about you?
Thanks, Kirk. Sorry about what's going on today. So really it comes down to it. I talked a little bit about inflation, a little bit. We've got some things that are changing here with, a lot of job losses, a lot of concerns that people have. And then, of course, one of the things that's coming up with that is that people, whether, if you're in a family, no matter what you face, you're going to be facing the potential of having to pay for your kids to go to college. And what I want to make sure that people understand is that a lot of people lose money unknowingly and unnecessarily on college costs while leveraging financial planning strategies that unfortunately may not be making the difference that they need to make. So I want to, if you want to make sure that you're going into this and figuring out how to make sure that your financial house is in order and stays that way forever, you want to make sure that you understand how to make financial decisions that are not based on outdated or misleading information. At Mergent College Advisors, we specialize in helping families not just save for college, but on college, helping you cut costs, maximize financial aid, avoid unnecessary expenses. And the difference between being informed or an uninformed college buyer can lead to tens of thousands of dollars, which can actually add up to hundreds of thousands of dollars over your lifetime. So go to mergentcollegeadvisors.com, MERGENT, collegeadvisors.com. If you want to understand how we help families navigate scholarships, financial aid, tax strategies, or even business and estate planning moves that can legally and ethically reduce out-of-pocket college costs. Because if what you thought you knew about paying for college and all you're doing financially turned out to be wrong, when would you want to know? The earlier, the better. mergentcollegeadvisors.com, MERGENT.
Awesome. Well, thanks for coming on, Doug. And that's the show for this week. Next week, we'll continue to dive into the Berkshire Hathaway annual report. We'll get into a lot of updates. There's a lot of interesting stuff we didn't get to this week, but we'll get to next week. So that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.